Most retirees think taxes disappear after they stop working, but one simple mistake could cost you tens of thousands of dollars. If you think your tax bill ends with your final paycheck, you're in for a massive shock. Today, we are uncovering the hidden tax traps that catch even the smartest savers off guard. We will reveal a retirement tax strategy that can save you a fortune using a real-life example of how one couple almost lost a significant portion of their nest egg to the IRS. If you are retiring soon, or even if you are just starting to plan your career path, this information will change your entire financial strategy. Understanding how to manage your wealth in the transition from the accumulation phase to the distribution phase is the difference between a comfortable retirement and one where you are constantly looking over your shoulder at the taxman. The problem is that taxes do not vanish when you retire. They actually become much more complex. When you are working, your taxes are relatively straightforward because you have a W-2 and clear tax brackets. In retirement, you suddenly face hidden taxes that most people never see coming. First, there is the taxation of Social Security benefits. Depending on your provisional income, up to 85% of your Social Security can be taxed. Then there is the Medicare ERMA surcharge. This is an income-related monthly adjustment amount that increases your Medicare premiums if your income crosses certain thresholds. It is essentially a stealth tax on high earners and successful savers. There is also the net investment income tax, or NIT, which adds an extra 3.8% tax on investment income for those above certain limits. And let's not forget the alternative minimum tax, which can still trigger for certain retirees. The biggest issue is that many retirees unintentionally push themselves into higher tax brackets because they have a poor withdrawal strategy. They think they are being smart, but they are actually creating a tax time bomb that will explode later in life. The most common mistake people make is following an outdated withdrawal order. For decades, the traditional advice has been simple. Spend your taxable brokerage accounts first, then move to your pre-tax IRA and 401k accounts, and finally, touch your Roth accounts last. On the surface, this sounds logical because it allows your tax-advantaged accounts to grow for as long as possible. However, this is often a very costly error. By letting your pre-tax accounts grow too large for too long, you are setting yourself up for massive required minimum distributions, or RMDs, once you reach age 73 or 75. These mandatory withdrawals can be so large that they push you into a much higher tax bracket than you were in while you were working. This triggers higher taxes on your Social Security and forces you into those expensive Medicare ERMA surcharges we mentioned. Letting pre-tax money grow unchecked is like letting a weed take over your garden. Eventually, it becomes too big to manage without a lot of pain. To see how this works in the real world, let's look at Jim and Carol. They are a relatable couple who worked hard and saved $3 million for retirement. $2 million of that was in Jim's traditional 401k, $500,000 was in a brokerage account, and $500,000 was in Carol's Roth IRA. They followed the traditional advice and spent their brokerage account first to pay for their early retirement years. For the first 10 years of retirement, their taxable income was very low, and they felt like they were winning. However, because they didn't touch the $2 million in the 401k, it continued to grow at 7%. By the time Jim hit his mid-70s, that account had ballooned to over $4 million. Suddenly, his required minimum distributions were over $150,000 a year. This forced income, combined with their Social Security, pushed them into a high tax bracket they never expected. They were paying tens of thousands of dollars more in taxes than they would have if they had planned their withdrawal sequencing differently. They missed a golden opportunity to fill up low tax brackets in their early retirement years, and it cost them a significant portion of their lifetime wealth. Here is what they could have done differently to save tens of thousands of dollars. The solution starts with using your low-tax early retirement years strategically. If you retire at 62 but don't have to take RMDs until 75, you have a 13-year window where your income might be naturally low. Instead of letting that space go to waste, you should withdraw some pre-tax money early to fill up the 12% or 22% tax brackets. By taking the money out now at a lower rate, you reduce the size of the total account, which in turn reduces the size of your future RMDs. This is a proactive retirement tax strategy that levels out your tax bill over time rather than letting it spike later. Another powerful move is harvesting 0% long-term capital gains. If your taxable income is below a certain threshold, roughly $94,000 for a married couple in 24, you can actually sell assets in your brokerage account and pay $0 in federal capital gains tax. This is a massive opportunity to reset your cost basis or get cash out of your investments for free. Timing is everything here, and you must stay under the thresholds to keep that 0% rate. But doing this early in retirement can save you thousands in future taxes. If you have concentrated stock positions, perhaps from an old employer, you should also look to trim or donate those strategically. Large holdings in a single company create a huge tax risk if you ever need to sell them all at once. By selling small amounts each year during low-income years, you manage the tax hit. Alternatively, if you are charitably inclined, donating that highly appreciated stock directly to a charity allows you to avoid the capital gains tax entirely while still receiving a deduction. This leads into another great strategy: charitable giving through qualified charitable distributions, or QCDs. Once you reach age 70 and a half, you can send up to $100,000 per year directly from your IRA to a qualified charity. This money counts towards your RMD but is not included in your adjusted gross income. It is one of the most efficient ways to give and reduce your tax burden simultaneously. Strategic Roth withdrawals are another key component. You should not just treat your Roth as a last resort. Instead, use Roth distributions to manage your tax brackets in real time. If you need an extra $20,000 for a vacation, but you are already at the top of the 22% tax bracket, take that money from the Roth. It won't push you into the next bracket, and it won't trigger those Medicare surcharges. Having tax diversification is the secret to total control. You want to hold money in 3 buckets: a brokerage account, a pre-tax account, and a Roth account. This gives you the flexibility to choose where your paycheck comes from each year based on the current tax laws and your specific needs. If you are still in the saving phase, you need a blueprint to build this flexibility now. First, start practicing tax loss harvesting in your brokerage accounts. This allows you to offset gains with losses and carry forward extra losses to future years. Second, consider a Roth conversion ladder during any low-income years, such as if you go back to school or take a sabbatical. Converting pre-tax dollars to Roth dollars when your tax rate is low is a brilliant way to lock in permanent tax savings. You are essentially paying a small toll now to avoid a massive tax bridge later. The goal is to prepare yourself to fill multiple tax brackets efficiently so that when you finally stop working, you have a toolkit ready to go. The key takeaway is this: the biggest mistake retirees make is letting their pre-tax accounts grow unchecked without a plan for distribution. Taxes are not static. They are a dynamic part of your retirement that requires constant attention. If you wait until you are 75 to think about taxes, you have already lost the game. Early planning and smart withdrawal sequencing can save you hundreds of thousands of dollars over the course of your life. Remember these steps: fill your low brackets early, use the 0% capital gains rate while you can, and always maintain tax diversification between your different account types. Taxes in retirement are too important to guess. Every dollar you save in taxes is an extra dollar you can spend on your family, your travel, or your legacy. Do not let a lifetime of hard work be diminished by a lack of planning in the final miles of the marathon. You deserve to keep as much of your money as possible. Get a plan tailored to your specific numbers and start implementing these strategies today. If you want to dive deeper into how this applies to your specific situation, seek out a professional who specializes in tax-efficient withdrawal sequencing. The sooner you start, the more you save. Start taking control of your financial future right now.